This is brought to you by John Daniel Partners LLP.
Thank you for joining us today for this webinar. Welcome. My name is Frida Babu. I work at John Daniel Partners LLP. We are a CPA firm based in Nairobi, CBD. We normally hold these free webinars on monthly basis. And the key aim of the webinars is basically to empower SMEs and business owners to stay informed on matters to do with taxation and how to make their businesses thrive and make profits as they focus on the success of their businesses. So we are here to empower businesses to grow. And our webinar today is on tax and compliance essentials for growing our businesses. Thank you, dear Lord, for this wonderful morning. Thank you for the gift of life. Thank you for the gift of one another, oh God. Thank you, Father, for the people who are gathered this morning to attend this webinar, the various business owners or people who are looking forward to start their businesses. We pray that, Lord, you may be Lord over this session, O King of Glory. May you open our inner eyes that, Jesus, we may understand whatever we are going to learn this morning. Thank you, Father, for you are good and you'll guide us even to help us thrive in our businesses. We thank you and we bless your name. In Jesus' name we pray. Amen. At this juncture, I'd like to welcome each and every one of us. You can use the chat section area to type the name of your business and what you deal with and your expectation for today's webinar. If you are comfortable to unmute, you can unmute and state the business that you are running and your expectations for today's webinar. If not, you can type it in the chat section area. And as the webinar starts, I would like to request the participants to please stay muted unless if you want to ask a question, but there will be a room for question and answers at the end of the presentation. So yes, welcome. Feel free to chat. Drop a chat, introduce your business. What do you deal with? What are you looking forward to learning today? Yeah. Thank you, Tabitha. She runs a business by the name Life's Lemons Coaching, and she offers ADHD and life coaching services. Her main goal is to increase her understanding of how taxation works for SMEs. Thank you so much, Tabitha. We are hoping we will be able to meet your needs. Thank you, Immaculate. Immaculate Nkadha. She's an agripreneur specializing in rice and honey. She also owns a clothes shop. Her expectation is to learn and understand how taxation works for SMEs. Welcome, Immaculate. We hope to meet your expectations. Brian Kipkirui says is looking to start an LLC in mobility space and wants to gain knowledge on how taxation works, both basics and advanced. All the best, even as you look forward to start your LLC. And we hope that works for you. And we are hoping to meet your expectations today. Thank you so much. The 2 minutes are over. I don't see any other comments. So at this juncture, I take this opportunity to welcome you all, the 24 of us gathered in this place today, to our today's webinar. As I stated earlier, we are John Daniel Partners LLP. We are a CPA firm based in Nairobi, CBD. We normally hold free webinars on monthly basis, and the key aim of these webinars is to empower SMEs to thrive and focus on generating profits. And we do this by holding webinars to do with taxations and also to keep them informed on any updates from KRA and how they can remain compliant. My name is Frida Frida Babu, and I work at John Daniel and Partners LLP. Our speaker for today is CPA Beatrice Wangoi. She works at John Daniel and Partners LLP. She heads the tax department. So welcome everyone. Feel free to type any question that you may be having in the chat box, and we will address those questions as the meeting progresses. We have a team of other professionals from John Daniel who are on the standby and are willing to answer any tax questions that you may be having. Welcome. Beatrice, if you can hear me, please, you can take over. Thank you so much. Oh, sorry. Before Beatrice, you come in, I can see another introduction from Anne. Anne is a lawyer who specializes in legal and tax compliance, governance, and company secretarial services. Welcome, Anne. Thank you for joining our webinar today. Welcome, Beatrice.
Thank you, Frida, for that warm introduction. Good morning, everyone. I wish to thank you all for availing yourself as we have this discussion and conversation on how we ought to be running our businesses in the right way, and also how to ensure that we are on the right and safe side when it comes to taxes and compliance. Maybe before I proceed, somebody can confirm that I'm audible and that you can all see my screen. Maybe Frida?
Yes, Beatrice, we can see your screen and you are audible.
Okay, thank you. So for today's discussion on tax and compliance essentials for growing businesses, we are going to be looking at the basics that every business in Kenya should know when it comes to regulatory and tax compliances. So for the content, we are going to have an introduction. Then we cover the business structuring and registration. Then understanding the various tax obligations for various businesses that we have here in Kenya. And then we have a section on the key tax audit triggers. And then a section on the compliance mistakes to avoid, you as an individual and also as a business owner. And then we're going to have a question and answer session. So feel welcome, and in case you have any questions, please list them under the chat box, and my colleagues will be answering them in the course of this conversation. So when you talk of compliance, what does compliance mean for us and our businesses? Compliance is basically about conducting businesses according to the legal and regulatory requirements. You can think of compliance as driving a car on the road. If you follow the traffic rules, one thing that you'll always have to your advantage is that you'll avoid trouble with the police and the people on the road. The same case applies to businesses. If you follow the rules set for businesses, be it tax compliance, be it regulatory compliance, be it industry-specific compliance requirements, you will always be able to run your businesses in a smooth way, and you'll be able to avoid any unnecessary interruption. When you talk of compliance, most people tend to think of it as just a legal requirement that you need to abide by just to avoid trouble with the government. But the truth is that compliance is not just a legal requirement. It can also be a strategic business tool that in case you use it in the right way, you are able to earn a number of benefits from it. And I believe these benefits are quite significant, especially when it comes to enabling your business to succeed in the long term. Among these benefits, we have one, it protects the business from penalties. We all know how penalties can be hefty for businesses. A good example of a case in point where we saw huge penalties affecting businesses could be the case in point of Access Bank. In March this year, they were penalized 91 million for failing to remit taxes that they had collected in June 2024. So you can just imagine the type of burden that gives to such a bank. Then the other thing that compliance can do for you, it will protect your business from audits. You see, what happens with KRA and taxes is that whenever KRA suspects that you're not paying your dues or tax dues, they'll go ahead and flag you for audits just to come and investigate whether you're paying the right amount of taxes. The other thing that compliance can do for you, it will enable you or protect your business from losing its reputation. We have all seen some famous supermarkets being shut down by the county due to compliance issue, especially when it comes to food handling. You can just imagine the kind of image such a supermarket create in the public. So compliance will also protect you from that. It will enable you to have a good image in the public eye. Then the other thing that compliance will do for you, it will enable your business run without any interruptions. So in the example that you have talked of, a supermarket being closed, you can just imagine if you close that supermarket for 1 week, 2 weeks, what happens is that this becomes a loss to the business, which can take time to recover from. Then compliance will also help you build trust with your clients and partners. And this is mainly when it comes to bidding for tenders. For those of us who have interacted with tendering, you all know that you're required to provide a tax compliance certificate. And in case you're not able to provide such a document, you're automatically disqualified, regardless of how good your product or service is. So you can all see how impactful compliance can be for your business. Then the last thing that compliance can do for you is that it will enable you have sustainable growth for your business. And by this, you'll be able to track your performance and improve your decision making. You see, one thing with compliance, you are able to keep proper books of accounts. You are able to record your sales, your purchases, your expenses, and also your taxes. And with that, you are able to know the true position, the true financial position of your business. And from that, you're able to make informed decisions that are based on something that is true. Unlike a person who just because they're making sales, they think that they're making a profit. So it is very important to have compliance as one of your goal when it comes to your business management, because it will always ensure that you're making decisions that are based on true information. Now, we also have the other side of compliance. Now, the non-compliance bit. We always say that non-compliance today is costly tomorrow. Because in case you fail to pay your taxes to KRA, we all know that taxes have due dates. You ought to be paying certain taxes at a certain time. So in case you're not able to pay those taxes by that time, they'll come along with penalties and interest, which is an extra cost to the business. The other thing of non-compliance is that it will damage your reputation. You'll not have a good image in the public eye. So with that, you'll see that people don't want to be associated with your business, and they will limit their purchases or buying from you when it comes to your business. The other thing is that if you're not compliant, you will lose opportunities. As you have seen, most of the tendering, most of the tenders that you apply for, you are required to provide documents such as the tax compliance certificate. And this certificate, you only get it once you pay all your tax dues. So in case you don't have such a document, you also lose very important opportunities. The other thing is that non-compliance will disrupt your business and you'll not be able to run your business in the right way. And at the end of the day, you'll find that you're making huge losses that could have been avoided could you have been compliant. Now, we can all see the good and the bad side of compliance and non-compliance. And it is my hope that most of us who are attending this webinar are on the good side, that is the compliance side, just to ensure that our businesses run in a smooth way and we avoid unnecessary interruptions in our businesses. Now, under this section, the next section, we are going to be talking about business structures. And when we talk of business structure, this is when you decide whether your business is going to be either a sole proprietorship, do you want it to be a company, do you want it to be an NGO, and so on. And this is where everything starts. I believe when you are starting, most of us, when you're starting our businesses, the first thing that we do after deciding on the product that we are going to sell and the people you are going to sell to, is now to determine whether we are going to set the business as a sole proprietor. Do you want it to do it on your own? Do you want it to have do you want to have it as a company, or do you want it to have as a partnership? So this is what you're going to be covering under this business structure section. Now, when you talk of the legal structure, as we have said, this is where you determine whether you want to run your business as either a company, either as a partnership, or a sole proprietor, or even an NGO. We have many types of business structure, but our today's focus will be mainly on the four of them: the company, the partnership, the sole proprietorship, and then the NGOs. Now, the moment you decide on the legal structure for your business, you are determining the foundation for your long-term success, because the legal structure that you choose for your business determines a number of things for that business. One, it will determine the tax obligation. These are the types of taxes that you pay for that business. As you're going to see later in our discussion, the types of taxes that are paid by a sole proprietor are not necessarily paid by a company. And the same case applies to a partnership and an NGO. So we are going to be expounding on the different taxes for the different types of business structure, and you can tell the differences between the taxes paid by either of these types of business structures. Then the other thing that the business structure will determine for your business is the legal liability. Now, when you talk of legal liability, you think of it as the extent of financial risk that the owner of the business is exposed to. As you are also going to see in our later discussion, when you come to a sole proprietor, the owner of that business is solely exposed to financial risk in case the business is not able to pay off its debts. Unlike when it comes to a company, whereby they have the limited liability aspect, whereby they are protected. The owners are not exposed to any financial risk in case the company is unable to pay its debts. So we are going to expound further on that as we move on. And then the other thing that the business structure will determine for your business is the compliance requirements. If you take a sole proprietor and a company, for a sole proprietor, the requirements are very minimal. You'll find that the only thing that you need is a business name and maybe the local license and permits, and then you're good to go. But now when it comes to a company, there are other compliance requirements, such as you are required to file your annual returns with the BRS, that is the Business Registration Service, per year. You require investors and shareholders, and you're also required to maintain proper books of accounts. But on the other side, when you look at the sole proprietor, it is not compulsory for you to put your books in order, that is maintaining the proper books of accounts. And then the other thing that the business structure will determine for your business is that it determines your ability to raise capital and win contracts. As you're going to see later on, for a sole proprietor, most of the money that you start your business with comes from your savings, maybe a loan from the bank, or maybe those chamas that we have in our societies. But now when it comes to a company, you'll see that you need investors, you need shareholders, and so on. So for a company, there are many ways of raising capital compared to a sole proprietor. So these are the four main things that the business structure that you choose for your business determine. And as we have said, it forms the foundation of everything. So it's very important that as you choose the business structure for your business, be aware of what you are signing up for. Know your tax obligation, know whether you want to have the limited liability or the unlimited liability, that is being financially exposed to losing money when it comes to your business, that is your personal money when it comes to your business, and also the compliance requirements, and also when it comes to you sourcing for capital. Now, as we have said, we are going to be covering the four main legal structures that we have in Kenya. We are going to start with the sole proprietorship. For this one, we sometimes call it the business name. And this is a one-man business, meaning that it is owned and run by one person. I think this is one of the most common and simplest form of legal structure, because all you need is yourself, and then you go ahead and make registration for that sole proprietorship, and you can now start your business. So with this, with the sole proprietorship, we do not have any legal separation between the owner and the business. Take an example of, maybe we have a person by the name Amina. Amina opens a salon. We call it Amina Salon. So what we mean by not having a legal separation between the owner and the business is Amina and the Amina Salon are one person. They are treated as one person. So there's no difference between the salon and Amina. Now, some of the key features when it comes to sole proprietorship is that, as we have said, it is a single individual. It's a one-man business. Then when it comes to decision-making, the person, the owner of that business has full power, because he or she does not have to consult with any other person, and decision-making is fully up to him or her. Then the other bit, it's not a separate legal entity. I think I've explained this. We have said that Amina and the Amina Salon, they are one person. So there's no difference between the owner and the business. Then the other bit is on unlimited liability. When we talk of sorry for that, in case we talk of the unlimited liability, what we mean is that in this case in point where we are giving an example of Amina and Amina Salon, in case the Amina Salon is unable to pay off its debt, Amina is personally liable to pay off those debts. So you can all see the risk that we have for a sole proprietorship. You risk losing your personal assets in case your business is not able to pay off its debts. And in most cases, you'll find that this is quite a high risk, because it means if in case your business goes down, you also go down in terms of finances. So this is one of the disadvantages of being a sole proprietor, as we are further going to expound on now what are the advantages and disadvantages of having the other legal structure. Now for the sole proprietorship, the only thing that the registration is done online through the business registration service. It is in eCitizen. And the only thing that you need is a KRA PIN, an ID, and then 3 possible business names for your business. So this is a very simple process. The eCitizen is nowadays very upgraded, and I believe that anybody can do the business registration through the eCitizen. So now we move on to the tax and compliance requirements for the sole proprietor. That is the one-man business type of business. One, you'll see that business income is taxed as part of their personal income. As you have said, with the business and the business owner, when it comes to a sole proprietor, are one person. So the business income that you earn is treated as your personal income. And this income is charged to the payee or the individual graduated scale, and the rates are between 10 to 35%. And this should be filed by 30th June of each year. So in this case, if you have your business and you also have any other type of income, you're supposed to aggregate that income and then pay the tax due using the payee graduated scale that ranges between 10% to 35%. Now, the returns should include all incomes earned from the business and any other source of income. I want us to use the example that I had given of Amina. Amina has a salon. Now, you can all see that Amina is an individual, and then we have the salon as a business. But besides this, Amina also receives some commission for selling maybe some beauty products. So that means that Amina is also receiving commission as an income, so that's an extra income to Amina. Maybe let's say she also has a kiosk in the CBD where she rents out, and she also gets another income from that. So when it comes to filing the returns, Amina is going to aggregate all that income. That is the business income, that is the salon profit, and then you take the commission that she's getting, and then you also take the rent that she's receiving from the tenants. And then in total, she's going to subject that amount to the tax that ranges between 10% to 35%. And the net of that will give her the dues that she ought to pay to KRA. Now, when it comes to sole proprietorship and sole proprietors, there are a number of taxes that they should register for. These are the most common ones. One, we have the VAT, that is the value added tax. And for this, if you are sole proprietor, you only register for this if you are selling vertible goods that are above 5 million per year. And then the other one is on the turnover tax. And this one is at 1.5% of the gross month sales if your sales are above 1 million to 25 million. We are going to be looking further into these taxes and expound on how they work later on in our discussion. The other type of tax that is common for sole proprietors is the payee, and this is the pay as you earn. This one is deducted from employees' payment slip. Whenever you are paying them, you deduct this amount and then remit to KRA. And then alongside this, you're also supposed to register for NSSF, and then SHIF, that is the Social Health Insurance Fund, and then NITA. We are going to be covering all these taxes later on in our discussion. Then the other thing on compliance for sole proprietorship is the annual county business permits. And also in case you're operating in regulated industry, that is the specific industries that are regulated, you are required to obtain your industry licenses. Like for example, professionals like us, you need a ISPAC certificate per year. And then even for those, especially those handling the food industry, you're also required to have those specific industry licenses. So this is all that you need to know when it comes to compliances and taxes for the sole proprietor. And it is very important for you to understand how each and every item of tax or regulatory compliance requires from you, just to ensure that you're on the safe side when it comes to the authority and the other regulatory bodies. We move on to the next type of legal structure. We have the limited company. So this is a corporate body that is formed and registered under the Companies Act 2015. And this is different from the sole proprietor because it has the legal, it is a legal separate entity, meaning that the business owner and the business are two different people. And with this, the company is able to own property on its own. It can be sued and it can also be sued. So the business owner and the business are two separate people. Now, with the limited companies, shareholders have the limited liability aspect, meaning that in a case where maybe I'm a shareholder in a certain limited company, in case I own, let's say, 100,000 shilling in shares, the maximum amount of money that I can lose in that business is only the 100,000 shilling that I've invested in that company, even if the company owes millions. So the only thing that I risk losing is the amount of money that I've invested in that company. So that is what we mean by the limited liability aspect. I think you can now compare what we have under the sole proprietorship and the limited company. For the sole proprietorship, we had the unlimited liability. The person was personally liable to pay off debts in case the company was unable to pay it. But when it comes to the limited company now, we have the limited liability aspect where the shareholders are protected from losing their personal finances and assets. Now, for the limited company, the registration is also done online with the business registration service that is in the eCitizen. It is also quite a simple process. And then we have the two types of limited companies. We have the private limited companies and then the public limited companies. For the private limited companies, shares cannot be offered to the general public. Well, for the public limited companies, the shares are sold to the general public. And under the private limited companies, we have two types. We have the limited by shares, and then we have limited by guarantee. So the difference between these two is that when you come to the limited by shares, this is where we say that I am only exposed to lose the amount of money that I invested in that company. Just like the example that I've given, in case I have 100,000 shilling invested in a certain limited company, and the company goes into debt, I can only lose that 100,000. So that means that I have the limited liability aspect. And then when it comes to the limited by guarantee, this is mostly for non-profit making organization. And for this, we call them members and not shareholders, unlike under the limited by shares category. So here we have the members. And what happens with the limited by guarantee limited companies is that members agree on the amount of money that they're going to contribute in case the company winds up. Now, when it comes to the taxes to be paid by the limited company, the most common one is the corporate tax. And this one is charged at 30% for the resident companies, and then 37.5% for the non-resident. Now, when we talk of a resident company, this is a company that is registered under the Companies Act 2015 here in Kenya. And then the opposite applies to the non-resident. So in case it's a resident company, you tax it at 30%. So what we do is that we tax 30% of the profit that the limited company has made in a year. And the same case applies to the non-resident at that 7.5%. And then from this, the directors will be taxed separately. So because they are two different entities, as we have said, they are separate legal entities, meaning that there is no connection between the company and the directors. On to the tax and compliance on the limited companies. One of the compliance requirements is that limited companies are required to file their annual returns with the BRS, that is the Business Registration Service, every year within 30 days after the anniversary of incorporating. So someone may ask, what is the difference between the annual returns that we're filing in the BRS and the ones that we file in iTax? That is the ones that we file with KRA. So with the annual returns in the BRS, that is the Business Registration Service, this is where you just update information about your company. It could be that there are changes in the share capital holdings, changes in shareholders, we have maybe changes in location, and the registrar would also want to know whether your business is still running or you closed down. So these are some of the information that you provide when you're filing the annual returns. There's no point that you file the amount of maybe profit that you made when you are filing returns under the BRS compared to when you are doing the annual tax returns, where you do a self-assessment on the profits that you have made for the year, and then you pay the tax due. That is in the iTax. And then this annual filing should be done within 30 days after the anniversary of incorporating. Then the other thing that limited companies are supposed to do, they're supposed to prepare their financial statements according to the IFRS, and these statements should be signed by a director. So the financial statements will be the balance sheet, the income statement, the cash flow statement, and then the changes in equity statement. So, and these statements ought to be signed by a director. Then some of the tax obligations that a limited company must register for is the VAT, that is the value added tax, but this only applies if the company is selling vertible goods above the 5 million threshold in a year. Then the other one is the pay as you earn, and this one is in case you have employees and you deduct this amount from their salaries. Then the other one is the withholding tax. We are going to cover this later on in our discussion. Then we have the installment tax, the corporation tax, and a few others. Then the other compliance requirement for limited liability is that they are supposed to maintain accounting records for at least 7 years. So what happens with when it comes to KRA is that in case you are flagged for audits, and they come to audit you today, they are going to go back 5 years from now backwards. So that means that they are going to require your financial records all the way to 2019. So this also helps ensure that you have the right accounting records to support your business transactions. So the minimum is at least 7 years. Then the other one is we have the mandatory audit for companies with a turnover above 50 million. So audit is not compulsory for all companies, all the limited companies in Kenya. You're only supposed to do audit if you have sales above 50 million. But in case you are below this, you can also willingly decide to do an audit for your business, just to ensure that your business is running in the right way. Then in case you have employees, you're also supposed to register for other statutory deductions, such as the NSSF, the SHIF, which is the Social Health Insurance Fund. It was previously NHIF, and then the NITA. We are going to expound more on this statutory deduction later on in our discussion. Then the other requirement is on the annual county permits. And then in case you're operating in an industry that is highly regulated, you're also required to ensure that you have your industry-specific licenses updated. So ensure that you renew your necessary permits and licenses on time, be it annually or whenever you are required to renew them. So that's all about the limited companies. I want us to move on to the next type of legal structure. That is the partnership. Now, when you talk of a partnership, this is when 2 or more people come together to do business with the intention of making profit. So it's person A and person B have decided to come together to do business together, and then they share the profit. The partnerships are governed by the Partnership Act 2012, and the registration for the partnership is also done with the Business Registration Service. It is also on eCitizen, as we have said. And we have the 2 types of partnerships. We have the general partnership, and then we have the limited liability partnership. Now, when it comes to the general partnership, we do not have the a separate legal entity, meaning that the individual partners and the partnership business are one person. We do not have that aspect of having the business owner and the business being 2 separate legal entities. So in general partnership, it is one. There's no separate legal entity. And then when it comes to the liability, they have the unlimited liability, meaning that they are personally liable to pay off debts in case the partnership is unable to pay off its debts. Then when it comes to the limited liability partnership, this one is different from the general partnership in that it has the separate legal entity aspect, meaning that the partners, the individual partners and the partnership are 2 different peoples. Meaning that the partnership can enter into contracts, it can be sued on its own, and it can also sue. Then when it comes to the liability, limited liability partnership, that is the LLP, have the limited liability aspect, meaning that in case the partnership business is not able to pay off its debt, the individual partners are not exposed or are not liable to pay off that debt. So that is all about the limited liability partnership, that is the LLP. Now, when it comes to partnership, one thing that you'll note is different with other entities is that they are not taxed as separate entities, meaning that the profit that is made by a partnership is not taxed on its own. What happens is that the profit that is earned from that business is splitted among the shareholders. No, rather the partners, the individual partners, and then these individual partners are supposed to declare this profit when they are filing their annual returns. So, meaning that you don't have a separate tax that you can say a partnership pays. Rather, the individual partners are the ones who pay that tax. On to the next legal structure, we have the NGOs. the non-governmental organization, but nowadays we call them the public benefit organization. And these are non-profit voluntary groups that are organized for social, charitable, religious, cultural, and environmental purposes. And for this organization, they are not profit-making, and their aim is just to help with social, charitable, and other environmental activities. Currently, these ones, you don't need to register with the BRS as we have seen with other legal entities. You are supposed to register them with the PBO Coordination Board, that is the Public Benefit Organization Coordination Board, and this is governed by the PBO Act 2013. So you don't have to register them with the BRS. Now, for NGOs, most of us assume that NGOs are not supposed to be paying any taxes. But the fact is that unless an NGO is exempted from tax by KRA, they ought to be paying all the relevant taxes that any other business pays here in Kenya. So they ought to obtain an exemption certificate from KRA for them to be exempted for any type of tax. Then some of the compliance requirements for NGOs. One, they are required to file their annual returns, just like any other business. Then we also have some rules from the PBO Coordination Board, like maintaining proper books of accounts and also presenting audited financial reports each year. And then when it comes to the taxes that they should be paying, as we have said, an NGO is just like any other business, and they are only exempted to pay taxes unless they are approved by KRA and they have the exemption certificate. So among some of the taxes that they should register for is VAT, that is the value added tax. We have the pay as you earn, that is for the employees, and then the withholding taxes. As you have said, we are going to be looking more into these types of taxes, just to understand how they work. So those are the 4 main types of legal structures that we have here in Kenya. I know we have many other types of structures. We have the trust, the cooperatives, the kind of circles, and so on. But for today, our main focus was on the 4 main ones. Maybe you can tell us whether your type of business has been covered under the chat box as we continue. In case it's not covered, maybe next time we can consider having it as among our discussion and the type of taxes that they should be paying. Now we move on to the next session where we discuss about the different types of taxes that are common to businesses, many businesses here in Kenya. We are going to start with the corporation income tax. And this is tax that is charged on the profits made by a company or a corporate body per year. And this one is governed by the income tax cap for 70 section 19A. So what happens is that the profit that a company makes should pay a certain tax on that profit. And the rates are 30% for the resident companies. I think we have defined the meaning of a resident company. And then in case we have the non-resident company, we subject that profit to that 7.5%. And then in other special cases, we have reduced rates that apply to certain cases such as the EPZ. EPZ are the export processing zones. And then we have the special economic zones. So like, for example, when it comes to EPZs, they are given the tax holiday for the first 10 years, meaning that they don't have to pay any corporation income tax for the first 10 years of operating here in Kenya. Now, with corporation income tax, we have, in case you are late to file, there's a 5% of tax. There's a 5% penalty of the tax due, or 20,000, whichever is higher. So in case you are late to file your annual returns, that is the corporate income tax that we do it, that is done on annual basis. That is by the 30th June of each year. In case you are late to file, there's a 5% penalty on that tax, or 20,000, whichever is higher. Then in case you file but you are late to pay, there's a 5% of the tax due, and then there's an interest of 1% per month. That tax remains remains unpaid. So that's all about the corporation income tax. We move on to the next type of tax. We have the payee, that is the pay as you earn, and then we have the other statutory deductions. Now, when you talk of pay is a mandatory monthly tax deduction that you deduct from your employees' salaries. And you're supposed to remit, you as an employer ought to remit this tax to KRA every month on behalf of the employee. So what happens is that you deduct this pay from their pay slip alongside the other statutory deductions, as we are going to see. And pay is only deducted from employees who are earning above 24,000. So in case you have an employee, you as an employer have an employee who earns below 24,000, you should not be deducting any pay from their pay. Then the due date for filing and paying payee is the 9th of every month. So, like for example, the payee for this month should be due next month on 9th. That is 9th September. Then alongside payee, we have the other statutories that fall under this the pay slip. These are the types of statutory deductions that you deduct from an employee's pay slip. We have the NSSF, that is the National Social Security Fund. This one you deduct 6% of the gross earnings of that employee, and then the employer matches the same contribution, that is the 6%. We have the current cap at 4,320, that is for the employee, and the same case applies to the employer. So in total, you'll be having the cap at 8,640 for the NSSF. So that's the much that each employee should contribute when it comes to NSSF. Then we have the SHIF, that is the Social Health Insurance Fund. This one is the one that replaced the NHIF in March 2024. So for this, you deduct 2.75% of the gross earning of the employee. And it does not have a cap, meaning that the higher you earn, the higher the contribution to the SHIF, that is the Social Health Insurance Fund. Then lastly, we have the Affordable Housing Levy. This is deducted at you deduct 1.5% of the gross earning of the employee, and you're supposed to remit it alongside the payee. All these statutory deduction, that is the payee, the NSSF, the SHIF, and the Affordable Housing Levy are all due by the 9th of every month. So take an example of this month. All these statutory deductions should be paid by the 9th of September next month. So that is all on the pay and other statutory. The other type of tax is the installment tax. This one is an advance income tax that you pay periodically to KRA under the Income Tax Act. So this is more of an advance tax that you pay to KRA before you pay your taxes at the end of the year. And people who are eligible for these are individuals and entities with a tax liability above 40,000. So when we talk of a tax liability above 40,000, this will be guided by the amount of tax that you paid in the previous year. So maybe I can give an example. In case last year you paid 45,000 as tax, you're supposed to be paying the installment tax. But in case you paid tax that is below 40,000, let's say that 6,000, you're not liable to pay this installment tax. And mark the word individual, sorry for that, mark the word individuals and entities. So it is for individuals and companies or businesses. So it does not mean that it applies to either. It is both. If you are an individual and also if you are a business owner, you ought to pay this type of tax for your business. Then we have those exemptions, people who are exempted to pay the installment tax. One, we have the employees under the payee. So in case you are an employee and you are deducted payee, you're not supposed to be paying any installment tax. Then we have taxes that are final tax. Like, for example, we have the rental income tax. In case you are paying the rental income tax, you're not eligible to pay the installment tax. Then we have the TOT, that is the turnover tax. Also, in case you are paying that tax, you're not supposed to pay the installment tax. We call them the final tax regimes. So with these taxes, whenever you pay them, you do not have to declare the same when you're filing your annual returns at the end of the year. Then we also have the entities that are exempted, like the charitable organization. But this only applies if you have an exemption certificate from KRA. So in case you're a charitable organization and you don't have an exemption certificate from KRA, you're also supposed to be filing for the installment tax. Installment tax is paid in 4 installments. So you pay them in four batches. The first one, you should make it on the 20th of every 4th month. Then the next one on the 6th month, and then the 9th month, and the final one should be done on the 12th month. And then the balance of whatever you have paid as the installment tax vis-a-vis the actual amount of tax that you should have paid for that year should be paid by the 4th month after the year end. Let's take an example of a business whose financial year starts in January and ends in December. So for such a business, the first installment should be on the 4th month, which is April, the second one on June, the third one on September, and then the last one in December. And then if the business finds out that the amount of installment tax that they have paid for that year is less compared to what they have actually seen to be the tax they ought to pay for this year, that balance should be paid by April next year, the next year. So in this case, we'll have if we have this installment tax in 2025, the balance should be payable by April. That is 30th April 2026. Then in case there is an underpayment for the installment tax, we have a penalty of 20% of the installment tax due, meaning that if you underestimated the amount of installment tax that you're supposed to pay and you would underpay, there's a 20% penalty on that unpaid installment tax. So that is all about the installment tax. We move on to the next type of tax. We have the withholding tax. So with the withholding tax, this is tax that is deducted at source when you're making certain payments to people or businesses. Like for example, we have the professional fee. A good example would be maybe a business, you as a business owner have outsourced an accountant to do some accounting work for you. When you are paying them, in case they are above, you are paying them more than 24,000, you're supposed to withhold 5% of that amount if they are residents. But in case you are dealing with an accountant who is non-resident, you're supposed to withhold 20% of that pay. The other type is on commission. Maybe you have a salesperson that you pay commission, and this person earns above 24,000. You are paying them a pay above 24,000. So you are supposed to withhold 5% of that pay and remit to KRA. Then we have interest, be it you are paying, you are receiving interest from an investment scheme. You always get that you get that interest less 15% because the investment company that is paying you that interest withheld 15% of whatever you ought to have been paid. Then the other one is dividend. This one mostly applies when it comes to SACCOs. For those who are in SACCOs, they might have noted that whenever you are receiving your dividend, there's always a 5% tax that is deducted on that dividend. We call it the withholding tax. So for dividend, we have the 5% withholding tax, and this amount is also remitted to KRA. Now, for the withholding tax, you're supposed to file and remit it within 5 working days after payment or deductions. So the key thing to note here is about the 5 working days. It is not It does not include the weekends. It is only Monday to Friday. Meaning that if you withhold today, you ought to be paying within 5. So the due date will be on Wednesday. Now that today is on Thursday, you'll count 5 days, 5 working days exclusive of weekends. So the remittance should be within 5 working days and not 5 working days, 5 general working days. It's the working days, that is Monday to Friday. Then we have the other type of tax is the value added tax. This one is for businesses that have taxable supplies that exceed 5 million in a year. And examples of vatable supplies could be maybe you are offering training services to the public, be it you are selling the vatable goods, or even have rental properties that are commercial. So for this, you ought to pay the VAT tax on that service or good. One thing to note here when it comes to the rental income from commercial property, we are not talking of rental income from residential property. So in case it's residential, you're not supposed to be paying VAT. But in this case, if you have the commercial property, you ought to register for VAT. Now, VAT is due by the 20th of the following month. So you ought to file and remit VAT within by the 20th day of the following month. The same case applies. The VAT for this month will be due next month on the 20th. In case you fail to file your VAT on time, there's a 5% penalty on the amount of VAT that you ought to pay, or the 10,000, whichever is higher. And then in case you are late to pay, there's a 5% penalty on that tax. And then there's an interest of 1% per month on the amount due. So this is what we have on the VAT. It is very important to understand whether whatever you are selling is vatable or not vatable. Just for you to know whether you're supposed to register for VAT, and also understand whether you are making sales above 5 million. So in case you're above the 5 million, ensure that you also register for VAT. The other type of tax we have common to businesses is the rental income tax. And for this, we have the residential income tax between 288,000 and 15 million per year. Should pay the monthly rental income. So in case you're a property owner, a residential property owner, and your rental income ranges between 288,000 and 15 million per year, you're supposed to register for VAT. For the monthly rental income, that is the MRI. And this tax is charged at 7.5 of the gross rent received. And for this one, you do not have to claim any associated expenses. Meaning that in case you receive your rental income as 1 million, you're supposed to subject that 1 million to 7.5% without deducting any expense from that income. And this one applies only to residents only, not non-residents. For MRI, MRI must be filed monthly on or before the 20th of the following month. And in case you are a property owner and you have not received any rent for that month, you ought to register to file for nil returns. So in case you didn't receive any rent or income for any month, ensure that you have filed for the nil returns. Then we have the other type, other category. That is if you're receiving rental income below 288,000 and above 15 million per year. So for this one, in case it's a corporate tax is at 30% for the resident, and then 37.5% for the non-resident. And in case you are an individual, if you are resident and a non-resident individual, you are taxed. That rental income is taxed using the pay graduated scale that ranges between 10% to 35%. So it's very important for you as a business owner to understand whether you fall under the category A, that is between the 288,000 and 15 million, or you fall under the 288,000 and 15 million. Just to understand whether you're supposed to be paying the MRI or the annual regime. You're under the annual regime where you pay taxes at the end of the year. The other type of tax we have is the capital gain tax. This one is levied on the net gain arising from the sale or transfer of a property situated in Kenya, whether acquired before or after January 2015. So if in case you are selling a property or transferring a property to another person, the profit that you get from that transfer, you're supposed to pay a certain tax by the name capital gain tax on that gain. And this tax is at 15% of the net gain. So let's say, for example, you bought a land in the 2000 at 1.5 million. And then come this year, you sold it at 2 million. So there's a gain of 500,000, and that is what you subject to 15%. And this is a final tax, meaning that once you pay this tax, you do not have to declare it when you're filing your annual returns. Now, when it comes to the tax point, at what point are you supposed to pay the capital gain tax? Capital gain tax should be payable the earlier of one, when you receive the full pay for that transfer or sale, or when you register the transfer with the relevant authority. In this case, you're talking of land, so it's when you receive the pay for selling that land, or when you register the transfer with the Ministry of Land. So the tax point will be determined by whichever comes earlier. Then the person who pays capital gain tax is the person who is selling, the seller, the transferor, and not the buyer. The other type of tax that we have common for businesses is the stamp duty. Stamp duty is the tax that is levied on legal documents that relates to property transaction. Maybe you are buying or selling a property, and this one is paid by a buyer, unlike the capital gain tax that is paid by the seller. And the basis of determining the stamp duty is the value of the property. You have the various rates for stamp duty depending on the location of the property that you are transferring. In this case, we have for the urban land, it's at 4%. And then for the rural, we have the 2%. So that's all about the stamp duty. And you can also tell the difference between the stamp duty and the capital gain tax. The next bit will be on e-teams. I believe most of us are aware of the e-teams. This is the electronic system that we nowadays use to issue tax invoices, and it is real time, meaning that KRA can track your sales and purchases as they happen. e-teams is a requirement for every business that is carrying out activities here in Kenya, and it is upon every business owner to register for e-teams. We however have some exemptions for e-teams, like emoluments. These are salaries that you pay to the employees, and this is an exemption because we already have information of employees that you have in your business using the pay that we file on a monthly basis. Then we have the imports. This is an exemption because of the custom entry service system, the custom entry system that we have whenever you are importing things into Kenya. So KRA already has this data. So there's no need to have an e-teams invoice for this. Then you have the investment allowances, the airline passenger ticketing, and then interest. So in case you are paid any interest or you are paying any kind of interest, you don't need an e-teams invoice for such. So these are the main common taxes that are relevant to businesses in Kenya. I know we may be having others, but these are the most common ones for businesses operating here in Kenya. Now, I want us to move on to the next bit on the KRA audit triggers. This is all about what can trigger KRA to come and audit you. What can trigger them to send you an assessment letter. They want to come and assess whether you are paying the right amount of taxes and so on. So under this section, the question is, what can trigger KRA to come and audit your business? One, we have the payroll audit triggers. One of the triggers could be when we have differences in the salaries figure per account and then the pay returns. So when KRA comes to your business, they'll find that in your books of accounts, you have 10 employees. But when you go to the pay returns that you file on a monthly basis, you have 5 employees. So they will want to understand why the difference. Then we also have pay not paid on time. We have businesses that delay to pay on time. And this is also a trigger for KRA to come and understand why the delay in payments. Then the other one is when you have a significant fluctuations in pay. So let's say this month, last month you paid 50,000 of pay, but this month you pay 500. So they will want to understand why the significant change in the amount of pay that you ought to be paying. Then we have an unfiling and non-remittance of pay. So there are businesses and business owners who do not file pay completely, and KRA may want to understand, is it that you don't have employees such that you're not paying the pay, or is it that you are tax evading, you don't want to pay any tax on pay? So KRA may also flag you down for audits to understand this situation. The other type of trigger is the corporate tax audit triggers. One is the perpetual loss. We have businesses that have been operating for years, but they have never made any profit. So this is also a trigger for KRA to come and investigate whether you are hiding any profits and you don't want to pay taxes to the KRA. Then we have non-reconciliation of incomes as per the VAT return and as per your books of accounts. So this is where we have the difference between whatever you declared in the VAT return as sales and whatever you have as sales in your books of accounts. So in case you have any differences, KRA will also want to understand why the differences. Then we have when you have expenses without matching incomes. And in this case, maybe your business is not new, it's an old business. So KRA will want to understand why you're only incurring the expenses and not having any income. So that could also be a tax evasion strategy. So KRA may want to know why the case is as it is. Then we have the reputation of a tax auditor and an advisor. So this is where you find that maybe a tax auditor or an advisor has been flagged down by KRA or even ISPAC. So with dealing with such an auditor or advisor can also expose you to being audited because the authority have lost trust in such an auditor or advisor. So that is also a trigger for KRA to come and audit you to ensure that you are compliant with the necessary tax requirements. Then the other trigger is on the VAT audit triggers. We have sales per VAT return differs from the sales per accounts. As we have said, whatever you declared as sales in the VAT return that you do on a monthly basis is different from whatever you have in your books of accounts. Let's say, for example, in the VAT return, you declared sales as 1 million, but whenever they come to your books of accounts, they'll find out that your sales are 20 million. So that is quite a significant difference, and they may want to understand why that is the case. Then we have VAT refunds. Before KRA makes refunds for you, they most of the time need to audit you just to ensure that you are claiming the right amount of VAT. Then we have the late filing of VAT returns, and this is consistently. So you find that each and every time you ought to be paying for filing for VAT, you are late to file. So KRA may also want to understand why that is the case. Then we have the VAT claims by customer. So with the VAT claims by customer, this means it's the VAT on purchases. So KRA will want to understand whether, besides you claiming the VAT on purchases, whether you are also declaring the same for the VAT on sales. So they will want to see what marries what. So they will also want to see the sales VAT accompanying the purchases VAT. Then the other trigger under the VAT audit, the VAT is the non-compliance with VAT regulations. Like for example, you'll find people who charge VAT yet they are not registered for VAT. The other non-compliance that is common to businesses nowadays is the eatings. You'll find that you are registered for VAT, but you have not registered for eatings. That is also a non-compliance issue. Then we have the other type of triggers, the general audit triggers. One is with the intercompany transactions, and this is with subsidiaries and sister companies. So let's say your sister company is in a country that charges low taxes. Let's say the corporate income tax is less than 30%, let's say 25%. So what you'll find with intercompany transaction is that companies here in Kenya will transfer their profits to such low tax jurisdiction. So with such, you'll find that they transfer their profits to such countries to ensure that they pay less taxes. And then those countries will transfer their expenses in Kenya to ensure that the expenses in Kenya are inflated, and at the end of the day, you'll find that such companies will pay low taxes. So KRA is very keen with cross-border transactions to ensure that companies are not transferring their profits to other countries that have low tax rates. Then the other one is information emerging from audits of other entities that you do business with. So what happens is that, for example, if KRA is auditing company A, and then they see a huge chunk of money has been transferred to company B, and then they will want to find the trail of whether the money got to that company B. And in case they come to your business and find out that you are that company B, and you do not have such a transaction in your records, that will also be a trigger for you to be audited further. The other one is on informers, like for example, ex-wives, ex-husbands, employees, and competitors. These are people who are not happy with you. And for example, maybe an employee left the company when you are not in good terms. So this employee may communicate with the KRA authority just to inform them that you have not been paying your taxes. So this is also a trigger. The other one is media, when it comes to TVs, newspapers, magazines, and internet. We have people who are living large on social media, but when you go to their tax records, you find that they are either filing nil returns or they are not paying taxes that are equivalent to their lifestyle. So in such a case, this is also a trigger for KRA to audit you. Then we have whenever you're dealing with big public companies, this is common. When you're dealing with companies such as the KCC, the Kenya Airways, there's a high possibility of having you audited, especially if you're transacting huge amounts of money with them. So these are the main general audit triggers that can result you to being audited by KRA. Now we move on to the next bit. As we conclude, we have the mistakes to avoid for businesses to ensure that you are compliant, and to also ensure that you're on the safe side when it comes to taxes and other compliances. One is mixing of personal and business money. This is when you mix personal and business money, you're not able to tell the true position of your business. You're not able to tell whether you're making a profit, or maybe you are paying the less amount of taxes, or what is happening, the actual position of that business. So at the end of the day, you'll find that sometimes you overpay your taxes, sometimes you underpay. And the worst could be that you are underpaying. And once you underpay tax and KRA catches up with you, you're supposed to pay that tax and also a penalty and interest. So it's very important for you to differentiate between your personal money and your business money, just to ensure that you have the true financial performance of the business. The other one is on ignoring KRA messages and emails. This can be quite consequential, especially if KRA is sending you very delicate messages and emails. Like, for example, we have those emails that they send you concerning assessment. They want to assess you. Or when they send you demand letters demanding for certain amount of taxes that are unpaid. So with such cases, you'll find that in case you ignore those messages and emails, KRA may go ahead and put other strict measures for you. Like, for example, they can send agency notices to your customers. And with the agency notices, what happens is that KRA requires your customer to pay them directly and not to pay you. And then we also have cases where they freeze your bank. You're not able to carry out any bank transactions. Then the other mistake that is common for businesses is not keeping the proper books of accounts. You're not able to have the invoices. You don't have any agreements. You don't have any paper trail to support your business activities. So in such a case, in case KRA comes knocking at your door and they want to audit you, in case you cannot support your transactions, then there will be an issue and you might end up paying taxes that you are not even supposed to be paying. So it's very important to ensure that you have proper books of accounts. You maintain each and every document that supports all the business activities. Then we have failure to renew the licenses. I think we have spoken about this. We have said that ensure that you have all your permits, all your annual permits and your licenses are well updated and you have renewed them, be it annually or wherever you are required to renew them. Then lastly, we have ignoring the tax updates. As you all know, tax changes over time. Nowadays, we have a finance bill each and every year, and each finance bill comes with its changes. So it is very important for you and your business to be updated on whatever changes we have in the tax world. So ensure that you are aware and understand whatever has changed when it comes to taxes. So I think we have come to the end of this discussion. Before I hand it over to Frida for any questions that we may have under the chat box. Frida, if you can hear me.
Yes, Beatrice.
You can take up and maybe you can go through the questions that we have under the chat box.
Okay. Thank you so much, CPA Beatrice, for that wonderful and eye-opening presentation. We truly appreciate. Maybe before we move to the question and answer session, if you have any parting shot, would you like to state it right now or later?
Frida, maybe we can first cover the questions and then after that I can give my parting shot.
All right, thank you. I see most questions have been addressed by John, CPA John. If you can hear me, please unmute and lead the question and answer session. Thank you.
Thank you, Frida, and everyone. Also, Beatrice, for that wonderful presentation. I've been answering questions from most of the participants. So in case any question is not clear, please you can unmute and ask a question that you may be having in the next like 5 minutes. But I've tried to answer most of what the attendees have been asking. Maybe one last that I can see why they're asking, any general comments on tax compliance of self-help groups? Yes, okay, it depends on the structuring. Just like Beatrice had mentioned, because taxation is quite definite. It doesn't happen in ambiguity. It is mostly very clear, even if you are to go to the law. So depending on how you structure your self-help group, I understand there are some self-help groups that are registered and maybe companies limited by guarantee. Others, they are NGOs. Others, they are CBOs. So for you, for example, to get tax compliance, tax exemption, if you are not doing anything that is for profit, you will need now to adhere to the requirements under the PBO Act, so that now then you can apply to KRA for tax exemption. And from there, you will just need to be filing nil returns. It's good to mention also, by the fact that you are exempted by any reason from income tax, the law requires you to continue filing your returns, but in that case, they will be nil. So that is a mistake that we've seen some clients make. When you are exempted, you continue to file, because filing is for everyone, whether you are exempted or not. But now you'll be filing nil returns. Okay, I hope I've answered that question to Anne satisfactorily, but if not, maybe you can unmute and ask for clarity. Okay, great. I've seen your comment. Do we have any other question, maybe from the members or anyone that I have omitted in my responses? I can see some people asking whether the notes will be shared. Yes, we will share this via the emails that you registered under. Anyone with a question? Maybe I'm giving maybe one last chance. I can see your comment, Tabitha. Thank you. As we await maybe additional questions or comments, I'm CPA John Thumbi. I work with Beatrice and Frida. I'm the client service manager for the firm. And part of what I do is just to ensure that we serve our clients in the best way, whether it is in audit, whether it's in tax advisory, whether it is in accounting, whether it's in payroll management, or whether it is in just general or management advisory. I want to share something that is upcoming. We are a firm that believes in educating the public in matters tax and compliance. And I think that's part of our CSR, corporate social responsibility, to ensure that the public is aware of the tax changes that are happening. And we are also able to guide, sometimes pro bono, sometimes in customized charges. Yes, because one of our objectives is to see businesses thrive. And we have two upcoming events that mirror what we have just done today, but these ones will be deeper. We have an upcoming tax and compliance essentials webinar, mostly for the construction industry entities. This one will happen next week on Thursday 4th. From 3 p.m. to 4:30. And from this poster, you can see the topics that we'll be handling, among others. These are just the basics, but based on our discussions, we can extend that conversation if time allows. But since we cannot exhaust everything, you see, tax is very broad. Compliance is very broad because we are not just discussing tax. There are other compliance requirements for businesses. That's why we have curated a tax masterclass that now allows us to go deeper, to delve deeper into these issues. And we are offering it at a discount. We decided just like we've been doing these free webinars, we'll try as much as possible to make these tax masterclasses as affordable as possible, so that the people who have been requesting that we do this, they are able to take advantage of this and learn the areas or the issues that we may not exhaust in these webinars that we do in every month. So we have one that is upcoming in the month of October, and we'll discuss broader and deeper concepts in terms of tax. This is where we'll discuss everything in the 5 days, from Monday to Friday, 2 hours every day. So it is 10 hours of intense learning for just 10,000. And I encourage us, if you have interest to know more about tax, even for your business, and even for personal knowledge, we highly encourage you to register for this webinar, not webinar, but tax masterclass. The poster is in our socials, and Frida will also be sharing details for the same if you want to register. Having said that, I think I'll head back to our questions if we have any. From the look of things, I think we don't have any other question. I can see Gideon Sang saying, CPA Beatrice and Frida and Thumbi for a good presentation. Looking forward for your next meeting. Yes, we conduct these webinars every month. Check out our socials for updates on what we'll be discussing next. We also have very detailed newsletters that we publish every twice in a month, that just tries to highlight recent tax updates and also other topical areas of tax, just to educate the masses or the public. I can see one last question from Elena. Hey, please comment about the tax obligations of a Kenyan working online with a UK-based organization. Thank you, Elena, for this question. This is one of the emerging issues in the realm of taxation, because we all know we are moving from the traditional working setup, and most of our people, they are now working online for global entities that are not necessarily based in Kenya. So just to answer your question, it will depend on what you are doing, number one. Then there are the key fundamentals of taxation, just like Beatrice explained. If you are doing this in an individual capacity, you will need to declare the income that you earn from this online work when you are filing your annual returns. And remember, KRA uses what we call a self-assessment mechanism. So you will need to declare voluntarily. For these ones, you'll need to declare voluntarily, because these ones, you may not issue an ETIMS invoice to the UK company. But you'll need to declare this at the end of the year, and then you can claim any expenses that you incurred in earning this income. Maybe you have rented somewhere as your office. Maybe you incur Wi-Fi expenses or internet expenses, and any other expenses that are admissible by the taxman. Then you may also experience a situation whereby these foreign companies, for example, one in the UK, they may tax you that income. So in instances where the country you are dealing with, maybe they have what we call a double taxation arrangement with Kenya, you can be able to claim the tax that you have paid in that jurisdiction when now you are declaring your incomes for the year in Kenya, so that you are able to offset what you should pay against what you had paid already. So I think this one will depend on a case-by-case basis. I hope that is clear, Elena. But if it's quite unique outside what I have explained, maybe you can reach out to us in person. Then we can be able to guide further. Thank you. If I don't know if we have any other question as we look to finalize, but Frida, you can take up if you had anything maybe to put across.
Thank you so much, CPA John, for handling that session very well. Beatrice, CPA Beatrice, if you're still around, you can give your parting shot, then I'll give my remarks.
Thank you, Frida. Maybe I can begin by thanking our participants for being patient with us. I believe we were supposed to finish at 11:30, but now it's 11:42. And also, as they leave, maybe I can encourage them to just remember that compliance is not just a legal burden, but also your business growth partner. So as you continue with your day, I would urge us to remember that as much as compliance may seem as a legal burden to us, let us also view it as our business growth partner. We have all seen how much compliance can do for us and the consequences that non-compliance has for us. So mine is just to wish you a good day too, and may you have a lovely and a blessed day. Thank you.
Thank you so much, CPA Beatrice. That was a very great presentation. At this point, I would like to thank each and every one of you for joining us today. It has been a great pleasure having you in this session on tax compliance essentials for growing businesses. And we hope that you found the session impactful. John Daniel, just as my colleagues Beatrice and John have shared, we believe that compliance and profitability go hand in hand. And our role as a CPA firm is to work with you on that journey, helping you to stay compliant while building stronger and sustainable businesses. These monthly webinars, we do these webinars on monthly basis, and our webinars are a way of giving back to the community. We want to share knowledge, start conversations, and provide practical insights that you can apply in your businesses. We will be hosting more free webinars like in the coming months. There is a free webinar like happening next week. This webinar, just as John mentioned, will be focusing on people in the construction industry, happening next week on Thursday. So watch out for that. We'll be happy to have you in that webinar. We will have a webinar at the end of September, another masterclass in October, and a webinar at the end of October. So just stay on the lookout. Watch out for like our social media pages. We normally post any event that we are having on monthly basis. So you are welcome. I'd also like to, make a small request. If you have found value in our today's session, please consider us as your partner for compliance and any advisory needs that you may be having. If you also know any other businesses that may benefit from our services, we'll truly appreciate your referrals. That's the best way you can help us to continue creating impact. The recording for today's session will be shared with you by close of business today. I'll share it in the emails that you provided so that you can be able to revisit the session at your free time for any part that you may have missed. On behalf of John Daniel and our entire team, we take this opportunity to thank you again for your time. We know it has taken more almost 2 hours, close to 2 hours. We deeply appreciate your time and your engagement and even your trust. You have trusted us to teach you. We don't take that for granted, and we really appreciate you, and we look forward to seeing you in our next webinar and to support you in keeping your businesses compliant and profitable. So stay compliant. That would be my parting shot. Stay compliant and see you soon in our next webinars. Thank you and good day. Because we started with a prayer, anyone in the meeting who would like to pray, feel free to unmute and pray for us, even as we bid each other goodbye till the next session. Thank you.
Okay, let's pray. God, we thank you so much for this day you've given us, for what we've been able to learn today, for the instructions we've received. We pray that you continue to help us remain compliant and bless our businesses, our entities. And we just want to thank you also for the firm that has taken time to train us. Bless their work and continue to guide each one of them. We give you thanks for this day. In Jesus' name, amen.
Amen. Thank you so much. Thank you.
This is brought to you by John Daniel Partners LLP.